A restaurant can be completely shut down, lose millions in revenue, and still face a coverage fight over whether the insurance was ever triggered. That is not a theoretical puzzle. It was the central problem in a Canadian case involving SIR Corp, the company behind approximately 60 restaurants, and Aviva Insurance Company of Canada. The restaurants were not experiencing a normal slow period. Government emergency orders had prevented in-person dining during the COVID-19 pandemic. Dining rooms were empty. Operations were disrupted. Revenue was lost. So here is the question we are investigating. If the business interruption is real, why did the insurance claim fail? This episode is based on SIR Corp. v. Aviva Insurance Company of Canada, a 2023 decision of the Ontario Court of Appeal. The Supreme Court of Canada later denied leave to appeal without giving reasons. The visuals are a dramatized reconstruction of the case. The narration distinguishes between what the public record establishes and what we are using to help explain the sequence. The important point is not whether one side was sympathetic. The important point is how a court connected the business loss to the words in the policy. For the shutdown orders, the restaurants operated in the ordinary way. Customers came into dining rooms, staff prepared and served meals, inventory moved through the kitchen, and revenue depended on customers being physically present. Then the operating environment changed almost overnight. Government orders prevented in-person dining. Restaurants had to adapt their operations, but adaptation did not restore the lost dining room business. The interruption was visible to every owner, employee, supplier, and customer. From the business perspective, the sequence looked simple. The order came first. The revenue loss followed. The policy contained business interruption language. A civil authority provision appeared to address losses connected to government action. That chain of events created a powerful expectation that the policy should respond. SIR sought a declaration that its commercial insurance policy responded to losses connected to the government orders. The reported case materials describe claims involving business losses and damage or loss associated with food and beer stock. This was not simply a request for an opinion about the word shutdown. It was a coverage dispute about how several parts of a commercial policy work together. Was the pandemic itself an insured peril? Did the government orders create a covered event? Did the civil authority wording expand the policy beyond physical damage? And did the business interruption section respond to lost revenue without the kind of property damage described elsewhere in the policy? The policy, as summarized by the court, insured the described property against direct physical loss or damage, subject to conditions and limitations. Its business interruption section addressed loss resulting from interruption or interference with the business when property was destroyed or damaged by a peril insured under the policy. There was also wording dealing with loss caused by an order of civil or military authority intended to retard or prevent a conflagration or other catastrophe. To a non-specialist, those sections can sound like separate doors into coverage. But insurance policies are generally read as connected documents. A coverage extension does not automatically erase the conditions or triggers that appear elsewhere. SIR's position, in broad terms, was that the pandemic and the government orders fit within the policy's wording. The civil authority language and the reference to a catastrophe mattered to that argument. Aviva's position was that the policy required direct physical loss or damage, and that neither the pandemic nor the shutdown orders caused that type of damage to the restaurant premises. SIR's story began with the consequence. The restaurants could not operate and lost revenue. Aviva's story began with the trigger. Before business interruption coverage could respond, the event had to fit the policy's definition of an insured loss or peril. This is the first reveal, and it is the distinction that gets lost in ordinary conversation. A business interruption is an event in the life of a business. It can mean that revenue stops, customers disappear, staff cannot work, or the premises cannot operate normally. Insured business interruption is narrower. It is an interruption that follows the triggering event, peril, damage, or condition described by the policy. The fact that the loss is serious does not decide the coverage question. The fact that the government caused the closure does not decide it either. The policy still has to connect the event to the required trigger. The Ontario Court of Appeal upheld Aviva's position on the wording and facts before it. The court found that the pandemic was not a catastrophe within the meaning of the policy and was not a peril covered by the wording at issue. It also rejected the argument that the civil authority clause created coverage where there was no direct physical loss or damage. The court's reasoning treated the civil authority language as part of the policy's overall structure, not as a freestanding promise to cover every government-ordered closure. The case does not mean that every business interruption policy requires the same thing. It does not mean that every civil authority claim fails. It does not mean that a pandemic, contamination event, physical impairment, or government order can never interact with insurance coverage. It means that this particular dispute turned on particular wording, particular policy structure, and particular facts. Before a loss, a business owner can ask a broker or qualified advisor for practical questions. First, what event triggers our business interruption coverage? Second, does the civil authority extension require physical loss or damage, and where is that requirement stated? Third, what waiting period, limit, supplement, or time condition applies? Fourth, what records will we need to prove the interruption, continuing expenses, saved expenses, and actual loss? Those questions are not a prediction of how a claim will be decided. They are a way to replace assumptions with a clearer understanding of the contract. The restaurants were shut down. The economic loss was real. The coverage question was narrower. Did the event meet the policy's defined trigger? That is the lesson from this case. Insurance disputes often turn not on whether something bad happened, but on what the policy requires before it responds. The most useful risk conversation happens before the doors close. When the policy is purchased, renewed, explained, and tested against the way the business actually operates. This has been an insurance case file. The source is linked in the description. The episode is educational information only, not insurance or legal advice.